Warriors, TGIF, NFP, Chimeng, how are you? Mike, how are you? Sinatra, AJ, everyone doing okay? Everyone ready?
Good early morning, Dale. Good morning, everybody.
Hey, how are you?
Good. You ready?
Dale.
I'm ready.
Are you ready for the
I'm
next?
ready to call it a week.
Got clean underpants on?
What's that?
Idea.
You got clean underpants on?
Yeah, I just changed them right before the start of the webinar.
Too much info, guys. Too much info.
Anyway, I was going to ask if it's great to hear your voice, Steve. Miss you here in F.A.C.E. You're just too busy to hang with us anymore. So let me start with you. Kind of week we had with the Fed. Minutes dousing some water on Bull's hopes, and then yesterday's what was it? The jolts. Again, the labor, the employment picture is something that the Fed is concentrating on, probably more than inflation now. What are you looking for today, buddy?
I doubt it that they are concentrating more on it than inflation, given the fact that one of them is a big problem still, right? Inflation,
Right.
not the labor market.
It's not part of the inflation problem, wage gains, a lack of a labor force to come in and, have competition so that employers don't have to keep raising salaries to keep people.
The reason salaries are going up, there was the old misunderstanding, because unfortunately in economics we have a lot of common theories that are completely mistaken. One of them was that labor costs were driving inflation, which is of course completely
that wage price spiral that people used to talk about.
It's completely it's completely insane, because thinking that wage increases cause inflation is like completely crazy, because what is the wage price? It's a price, right? And why do wages go up? Because the rest of the prices are going up. Why? Because of inflation. So wage increases is not a cause for inflation.
It's an effect.
It's an effect of inflation. As every other price goes up, the price of labor goes up as well.
Okay.
So it's as simple as that.
Okay. All right. I knew that if I said black, you would say white, and that's why I miss you. You're like the Phil Donahue. I don't know. Phil Donahue had a reputation of being the devil's advocate. He would say water.
No.
He would
I
say
didn't
oil.
say that. I didn't say that to argue with you. I've said it multiple times in the past. It is actually how things work. I think Peter Schiff has a good analogy with that. He has said, and I agree with him, because all in all, I don't agree with everything on.
I really think that you have a poster of Peter Schiff up on your office
not really
wall.
I disagree. I disagree with several things with him.
You know who else has a poster of Peter Schiff up in their office? Danny Blanchflower.
Kathy Wood.
No, Danny Blanchflower, because I'm a very big fan of his.
I'm sure.
Okay.
So
anyway,
he has a very good analogy. He says it's like he said that it's like seeing wet pavements and thinking that's going to cause rain, instead of seeing wet pavement and thinking, oh, it must have rained.
Okay. All right.
Having to do with
Yeah. Okay. Good to hear you, man. Hope Jason's feeling better.
Yeah, no, everybody's okay now. Now,
Everyone's
having
good.
to do with labor data, everybody's now assuming, obviously, that we're going to have strong NFPs, right? And it might as well be the case. Now, the obvious thing to say here, right, is that we get a good NFP number and the market is not going to be happy about it, right? Because the market is still betting everything on, enough of a slowdown in the economy and the labor market for the Fed to pivot soon. So, the more evidence we get that say that the Fed is not going to pivot fast, the more the dollar is going to be mounting a recovery rally here, and the more equities are going to remain in pressure.
Yeah. Okay. Do you have downside targets, Steve, for this wave?
Having to do with the S&P?
Yeah, I mean, this looked like a, impulsive move. We've moved sideways for a few weeks, resolve it to the downside.
I think it's more likely to be resolved to the downside. Yes, I think this is a consolidation after that rejection from the descending channel trend line resistance.
Yeah.
So the path of least resistance is lower. Now, how low can we go? We've for a
under
year
the
now,
October low.
Yeah, listen, for a year now, we've been producing lower highs and lower lows.
True.
So for the time being, we haven't broken that sequence. And yeah, there is a chance we can produce a lower low. So towards 3,400. Absolutely.
Okay. Maybe that's what's behind. I want to bring KMan and Ryan in on this. We ended up with a reversal week to the upside in US dollar yen. Comments on it, Kay?
Yeah, I think too much positioning, hoping for too much of a pivot from the Bank of Japan too soon. And as people were saying, 2023 should be the year of the yen. Well, usually when people pile into that, they get it, first of all, a little slap around the ears. And I think it's more about positioning than anything else that what we've seen here, together with a comeback of the dollar at the start of the year. And also the
Yields.
low print in dollar yen has been done while Japan was still on holiday. And since they are back online, they haven't been really buying too many yen. If you look at the yen crosses around the globe, not only dollar yen, they are also a bit higher than where we ended the year. So yeah, I think it's too much positioning, and let the real market wake up right now. And we have a lot of uncertainty around the BOJ still, and the BOJ is not the only game in town as well. And in the meantime, Bank of Japan is defending the 50 BP top end of the 10-year yield band, and you're still looking at a very low yield, right? With its own local economic issues.
So maybe we should be looking at fib retracements off this move from 52 to 130.
Yeah, I think 134.5 is already a good enough level to monitor the close above or below this week, because it's prior lows, the little high at the end of the year, and we're turning around. So that is one. And then you've got the other high there around, right where you are there, around 138. On good US data, it could go there. Why not? And if you get a bad one, and then we have to define what is a bad report coming up in 20 minutes or so. People are looking for 200K, but even if it would come out at 100K, that would still mean growth in the new metrics of what people have been saying lately. It's a couple of weeks or months ago, and even during our famous weekend, people were saying like anything above 60 or 70K job creation is not too bad. So even if it would come out at 100K, I wouldn't be going blindly selling dollars in on the back of it, depending on the other indicators, of course. But
pretty similar charts between the yen and the Dixie. Actually, the yen put in a stronger week. But any upside targets or downside targets in euro? I was thinking, from last week about 103.5.
Yeah, I think
here there's a lot of confluence right here.
Yeah, okay, that one. In the meantime, though, we've got a bit of a 104.5 in the mix. That's already going to be a decent benchmark, I would say, for the shorter term to close the week, whether we're above or below. Get back above 105. What is it? I think I've got something. If we close the week above 105, 35.40 or so, that might be looking a little bit better for the euro dollar. But then I'm not a huge fan of trading the dollar through euro because we've got this ECB in the background trying to catch
More
up.
against cable, and cable's
Yeah, cable
approaching
is going
some
to be
support here.
117.40.60, magic level to me.
Okay.
It's always been a point of where a new move has been initiated or stopped, or the old one stopped. It's been the case for many months, and 117.40.60 is going to be my big level that I'm watching on the cable. And then just one last thing that I wanted to add, and I'm glad to give the word to the others. You could also look at this labor report from a risk factor. So if the report is good, I think stuff like carry trades are going to pick up again, because stuff like the MEX has been behaving very well. Look at the MEX through the process. And I think it's a good US report, being partially the manufacturer of the US as well, and the proximity could give stuff like the MEX actually another lift, not so much versus the dollar, but versus like euro or yen or something.
Okay, I want to bring Ryan in and talk yields with you, buddy. So, you know, when I look at the 10-year, if I could bring it up here, eventually, there it is.
There
And
somewhere.
the way it held on this 4-hour moving average and this pullback to old resistance, new support, I could almost visualize a move to new highs in yields.
Yeah,
what do you think?
It's been a bit of a strange one, and as Kay was talking, that a lot of this move that we're seeing, particularly in dollar yen, is looking yen led. You look around at the bits and pieces, you know, you'd think with this dollar strength, everyone, particularly you guys in the US, everything's about the dollar, and everyone looks and thinks, oh, this is dollar strength. I'm not sure it entirely is. You know, we've had that good ADP data. Okay, it's light data. But you know, yields have never been shy recently of jumping higher on good data. But I think it's got to be really good data to get those yields up.
Because I think most of the market is, and I've kept an open mind, but I also thought that, these highs that we had up here in the yields, that might be it for a while, that it was, failing rally up here, and we've come all the way down here. But I think that it would be offsides to see yields from here. Most people would be offsides, caught by surprise. You're even having people say, well, you got to buy bonds now. If they win either way, the Fed pauses, or we have a recession and you're going to make money in bonds. But I don't know. This doesn't look that bearish to me right now.
No, but then the Fed have been nothing but hawkish and re-emphasizing they're going to get rates to 5% or their ceiling, and we haven't come close to the yields that we saw in the latter part of the year when all that was first coming into play. I mean, let me ask you a question, Dale. What do you think the Fed are going to hike at the next meeting? Just off the bat, basically.
I
50?
What the market's expecting, or maybe they'll go. They'll go a half.
They'll go a half. Do you know we're probability pricing a 25 over a half at the moment?
Okay, that would light things up. Okay,
that would light things up. Yeah, but this is a market that is supposedly hawkish on the Fed, and the data isn't doing too badly, and jobs growth is potentially good, and we're pricing a 25 over a 50 still, despite what the Fed
if you know that,
yeah,
Paul knows that, and if Paul wants to maintain credibility, he won't follow the market, because the market's not following him. He's going to make the market follow him. So maybe he goes 75. But I think he normally goes with what was expected. What's not expected is that he keeps going for another few meetings.
Yeah, I think he probably goes a 50 unless we get some really, really strong inflation data and jobs data and whatnot. But you're right what you're saying. The market is still underpricing the Fed, and on your question of yield,
they're not believing him. They're not
exactly.
believing him.
So your question on yields, why are yields at 3.75% and not trading over 4%?
Yeah,
You know,
because of
that's
that market, because this is what the market believes.
exactly.
So there's a
So
battle
what's
going on between
yeah,
what the Fed wants the market to believe and what they believe. They're
bingo.
fading Powell right now.
So if you're looking for a trade, what do you think the trade is? To short bonds, isn't it?
Yeah.
Yeah.
That would be the trade based on that psychology.
Exactly.
Okay. All right. Thank you,
And
man.
one thing I want to say quickly. I'm going to be interested in what stocks do over this number, good or bad. I want to see if we get the bad number stocks up or good number stocks up, because I think that's going to be important for this year to see how
I think
stocks
it's going
react
to be bad number, stocks up.
Yeah. Okay.
Okay. Where? Back to 3,900, 3,950? Or is this a important low for a move back to revisit 4,000?
You know, it's a wait and see thing. You can't predict in advance what's going to happen if we rebound. But one thing is for sure: the trend remains lower as long as the trend line resistance holds. And you know, people seem to be forgetting. I've been saying that for some days now, again and again. People seem to be forgetting that, you know, at the very beginning of this move, they started treating this move as another short-term pullback buying opportunity without recognizing that this move lower began when fundamentally things started substantially changing. Now, this hasn't changed, but now this is a trend that has been going on for a year. So it's not like a short-term pullback,
right? Like we used to get.
Yeah, by the dip, because being here for a year now, this move lower, it's gone way beyond a short-term pullback. So I don't understand why.
Can you, Steve,
Yeah.
do you know why with all of these waves down and everything, and you know, where the market is here despite the number, why VIX is trading at 22?
That is a very, very good question. The VIX.
I'm long VIX now.
Yeah, and we've been saying that the VIX has been has remained very orderly. Although to be fair, the move lower has been substantial. I mean, many people don't realize that in the year that passed, the S&P lost something like 18%, if I remember right.
Yeah.
The Nasdaq lost something like 30%. So, you know, big move there.
There's still no panic.
Yeah, and there's still no panic because, going back to what we were just saying, guys, because there is still this unbreakable faith that no matter what happens, if push comes to shove, and the Fed has to make a decision, they're going to rescue the financial markets. So that is still the ultimate faith behind this. That yes, okay, they're hiking rates and they're letting financial asset prices deflate, but they will never let this evolve to some kind of panic selling like we had in 2008.
Well, the year you just described, retail was buying and getting longer. They've trimmed recently, but they never sold out because they believed the market would come back. So that still has to happen, I think.
And I do think that there is a high probability that before this move is over and done, we're going to get at least some phase of panic selling.
Yeah, we take out 3,600, the October lows, or maybe even before that. Stel, you getting ready for maybe next week around the 22 and a half level?
Well, let's see. Regarding the NFPs today, my 2 cents. Unfortunately, I don't think they're going to be as important as the CPI readings. And this is because what has been the reason why the Fed has been hiking like crazy over the past year? Inflation. You know, employment has been consistently good. And like Steve correctly said, unemployment is not the issue. It's not the problem. So yes, a big outlier number is going to move the markets, but I don't think this is what's going to be driving yields or risk or anything. I think inflation is what everybody's looking at, what the Fed's looking at, and everybody's trying to second guess when the Fed stops. So Ryan correctly said that market's pricing a 50-50 roughly between a 25 and a 50. And the Fed they have explicitly told us that they're going to keep fighting inflation for as long as they need to, and the market pricing cuts this year is wrong. Now the market's playing a bit of chicken with the Fed, and unfortunately for the Fed, the market usually wins. That's the problem. But the market prices something, and then slowly the Fed kind of turns to that. But there have been cases where the market has got it wrong and reprices in a pretty violent manner. I still think that there is a good chance of that. But this is going to be for the next month or two. After that, I think, as I've said before, end of Q1 of this year, I think inflation is going to start really dropping. I mean, it's already dropping. Like the prints, today's print in the Euro CPI was 1 percentage point lower. And this is a pretty decent pace of drop, right? And of falling. And I think it's going to be the same in the US. But I think that for the short term, the risk remains that the market kind of agrees that the Fed might stay, it might go a little bit higher than expected in terms of rates, and that it's going to stay longer than expected by the current market. I'm not saying that this is actually going to happen. I'm just saying the market's going to reprice a little bit. So for me, the risk is still for a little spike in yields, like you showed, Dale. I think 4%. Is a nice round number, a nice round target. It's not that far away, and I think we could even challenge the previous highs at 430, whatever that is. And if that happens, then I think we see the S&P definitely challenging and probably breaking the lows that 3,600 or whatever that was, and going towards what I've been. In going towards what I've been talking about for over a year now, I think the pre-COVID highs at 3,300, 33 to 34. And I think a move towards there, especially if it comes pretty quickly, it's going to be enough for the Fed to step in and say, okay, let's do something to kind of stop this panic. It's not panic, right? I mean, if we go back to pre-COVID levels, it's not that the market's crashing. No, far from it. But
levels that were already elevated.
Exactly.
Right?
Exactly.
What was your number? Still 3,350, you said?
Between 33 and 3,400. I mean, 3,300. That was always.
Look at this line here. I mean, to me, it looks incomplete until this happens. So interesting that you have a number. I know it's not based on this line, but this line comes in right there. And as far as I'm concerned, Apple is broken, and it's got a worm in it, and it's a rotten apple, and I'd be eating pears for a while.
Anyway, I think there's a risk for that, and you have big names which have broken, like Apple. Okay, we don't need to talk about Tesla. Tesla is just trading unbelievably bad, but you have big names, Meta,
but
and
on the other hand, Tesla was like.
It was a huge
probably the biggest and more sustained bubble I remember seeing in a big stock. I'm not talking about the complete meme stocks like some kind of firecrackers that we had, like AMC and things like that. But the amount of faith and from the amount of people that was put in the story that Tesla can fly to the moon, and the valuation of Tesla is something I think is unprecedented, right? At some point, Tesla was pricing in that, I don't know, it's going to end up being not the only car maker on the planet, but probably in the next couple of planets, we're going to...
But by the way, Dale, Microsoft and Amazon, they are both on the brink. They're both on the brink. Look how close to those lows they are. Amazon the same. We had the COVID lows at what was it, $81.50. I think it's trading pre-market $82.50. So we are almost there. If those giants drop, fall below on a technical level, I mean, that's going to take everything, I think, with it. So you have to be careful. I do think
I think Microsoft can go all the way down to 190 again, if you ask me.
Yeah.
Yeah, I had a weekly up there. I mean, it's really as ugly as, so, the troops are already, they've been decimated. So all that was left when the troops retreat, they run behind the generals, and the generals were the only ones left standing, and they're being taken out.
Yeah.
So
And I mean, look
that's kind of near the end of or getting closer to the end of this sell-off. But this is what can create the panic, because these stocks you're talking about, plus Apple, are stocks that people felt safe in. They were like their bonds in the equity market, and now they're taking big hits.
And there's good reason for that, right? I mean, Amazon,
very good reason.
Apple, Microsoft. I mean, they're on a business level, they are monsters, absolute monsters. And on the long enough time horizon, they're going to do extremely well. But in the short term, obviously,
but the market had already priced in Stelio.
World domination, yeah.
Yeah.
Do one of you guys want to do what Blake does before the number and kind of grab the screen and put up our data flash and a few charts so we could watch the reaction?
I can do that.
Go for
I'll
it,
stop
Steve.
sharing here. And we do have Ben Maldonado coming in.
I like Ben.
Number. So
that's going to be great. Okay. So let me,
in terms of all these big names and the big stocks, I think we're going to get to really, really good levels to get long. But I just don't think we're there yet, because we went through a big period of just overvaluation in everything, unfortunately.
Extreme overvaluation.
Yeah. Yeah. So let's see. So we have 3 minutes to go.
Let's see.
Let's not forget, we also have average hourly earnings. That's always important. Unemployment. Yeah. We need to see the participation rate, all the little details, but obviously the whole world looks at the headline number. And
that is true. That's what moves the market, the headline number. Okay, here's the S&P.
We have Canadian employment as well.
Here's the USD yen on the bottom right. So let's see. Let me pull the USD CAD as well, because indeed we have, as always, Canadian data coming out at the same time. Here's USD CAD, which has been in a
great day yesterday with the
consolidation. Yeah. Actually, the Canadian dollar was until yesterday was holding up way better than other currencies against the dollar. But of course, at some point, something had to give, right? But in any case, I was saying yesterday on the Morning Edge that the USD NOK is performing much better. So if somebody's looking, for example, to be long one of the two, USD NOK is the obvious choice. Here you can see the difference, and USD NOK has broken through this descending channel. So that was, we were monitoring that before it even broke. That was a nice bullish breakout. So USD NOK, definitely the preferred choice to be long the dollar between the two of them. I'm saying between the two of them because very frequently people are looking for one or the other because they have some similar characteristics. They both can be influenced, for example, by, yeah, exactly. Now having to do with data, let me bring, here it is, the data flash. This is the what we have as expectations.
Oh, we can't see. Ah, there it is. Okay. Yeah, there it is.
Right. We have the previous NFPs were 263. The forecast now is for a 200. We had Canadian employment was very strong last time around 10.1. We have an expectation for 5. Keep in mind, Canadian data can be extremely volatile. We've seen that again and again. Canadian unemployment rate is expected to rise a little bit to 5.2. US unemployment rate is expected to stay exactly where it is at 3.7. So this is what we're waiting for, more or less.
One more thing, sorry to interrupt, one more thing to note, revision is important. And also let's not forget that these December number is always a bit weird because of seasonality and you know, some seasonal hiring.
You may want to go to a shorter TF Steve. So
These are the 4-hour
can-
charts, Dale.
order-
That's a shorter time frame I'm ever willing to go at.
oh, this is not for trading. This is just to show the drama of a candle. Go put
All
your
right.
1 minute chart up.
5 seconds. Let's see what we get.
3, 2, 1. Liftoff. Canadian. Ooh, massive Canadian.
Oh my God!
2
Look at
to
the
3.
Canadian.
2 to 3. Low revision. Oh, average hourly earnings quite a bit lower.
Yeah, and
so
unemployment.
like that.
Look at the big drop in unemployment both in Canada and the US. 0.2
That's very
lower.
strong. That's very strong for the US because the participation rate has gone up as well. So that's
Yeah.
a big number. But
Yeah.
wages have dropped.
Yes.
That's odd.
So I told you just before how volatile unemployment data can be, employment data can be in Canada. But to be frank, I didn't expect that the 5 forecast would become 104. Right? That's crazy.
In Canada, the same unemployment rate dropped and participation rate rose by 0.2. So that's very, very strong as well.
Yeah.
So people are working. The problem is, what kind of jobs are they doing?
Now, as you see, the initial reaction, the jerk-off reaction has been for the S&P,
up.
the S&P to strengthen. Keep in mind, I'm going to stick to what I said before. I don't trust this move higher, meaning I wish the markets functioned like that. At the good old days, good data was good, bad data was bad, which makes sense until the name of the game became central banks. And then they inverted, in essence, the pyramid, right? Because with central banks being there to hold the hand of the markets, what happened is that if you wanted your central bank to be more accommodative, you wanted some weakness, right? So then weaker data became risk positive, and stronger data became risk negative. And as you see, the S&P has already given up 3/4 of the prior jump higher. I think it's very likely following this data to actually get a breakdown from this triangle you see that we've been formulating for quite some time now, since the end of last year. This is a consolidation of the prior move lower. I think it is not unlikely to see a breakdown even today. Let's give more time for the market to digest the data. Undoubtedly, though, the initial reaction was for a weaker dollar and stronger equities. I don't think that's going to be lasting. I think we're probably going to end up having a stronger dollar and perhaps weaker equities as a result.
It's not a question of if to me on that triangle.
Yeah,
and I think it could be today too.
And if you notice, we have some strength in the Canadian dollar, right? It's already like 50 pips lower. The USD CAD is 50 pips lower, so Canadian strengthened more than the US dollar. Makes sense. Now,
I think the market
we have Ben here.
The wages number here.
Yeah, the wages were strong, right, Ryan?
No, weaker.
Weaker. Okay. All right. So then the Fed's getting what it wants right now.
Yep.
Yeah. US average hourly earnings. The previous was 0.6, which was revised lower to 0.4, and the current number came in at 0.3. In essence, we're following the trajectory we've already seen. Inflation, the rate of inflation moving lower, which makes sense. I mean, we couldn't keep going with inflation because inflation is the second derivative, right? In essence, so we couldn't keep on going with inflation being that high. But keep in mind, right, the rate of inflation is going down and probably is going to keep going down for some time.
Well, let's see what Ben Maldonado.
What is here to stay, though, is the price increases that we've already had. So people need to be cognizant of that. Anyhow, enjoy the interview. Enjoy the interview, Dale, and we're going to do further analysis, and based on what movements we get in the morning edge in 40 minutes
40
from
minutes.
now.
Okay, I need a cost of living increase. All right. Anyway,
Yeah,
Ben,
as much as you need a hole in the head, right?
yeah, I need that too. So I want to thank the team. Ryan already KMan left. Thank you, Ryan and Stel and Steve for covering pre-NFP and after. The dream team. Thank you guys.
Cheers, guys.
Cheers.
Thank you,
Cheers,
Dale.
Ryan. Ben Maldonado, welcome back to FA.C.E. Happy New Year, my friend.
Happy New Year to you, Dale, and Happy New Year to the boys, Steve and Stelios and Ryan and all the guys. It's great
Thanks
to
very
hear
much.
you guys.
Happy New Year, mate.
Happy New Year.
Thanks,
So,
fellas.
so great to catch up with you, Ben. You know, I remember from a past interview, you had some statement the last time we talked about that people were going to feel blue in December, that there was
Mm-hmm.
something in December. Am I recalling that correctly?
Yeah, that's true, and it's kind of a theme which we're gonna cover when we start the presentation, but it's kind of a thing that's gonna continue this year. It's sort of like there's gonna be no joy, and that's gonna weigh just psychologically weigh
No
on
joy in
people.
Mudville.
I think that's what odds favor is gonna be this year, because that's the background weather that we're dealing with.
Okay. You want to
So,
share your screen, buddy?
yeah, let me do that. Let's get this set up. There we go. You see it?
Got it.
Okay, so I asked Dale to have me on early in the year, and he accommodated, because I wanted to sort of set the table for what we're looking at this year from a cycle perspective, and sort of the background weather that we're going to be operating in. And so we start with the cycles, and then we'll go down to the technicals and look at the charts, and we'll throw in some fundamentals and sort of see what asset classes and what investments sort of make it through the three filters, and we'll end up on the bottom as places where we probably should have some money due to the positive expected value that comes from it. So what we're going to cover today is, and if you've heard my presentation before, you know these first two cycles, but I always bring them up because they are the foundation of where we are operating in. They are affecting every human on the planet. And because they are affecting them, they're affecting their psychology, and they're affecting their decision making, and they're affecting their economic choices. So it's going to have a major impact on the markets. So we'll briefly cover the epic cycle and developments there. We'll hit on a few things that Dale's favorite one, the connection with the 70s, and a couple other events that since the last time we spoke have sort of checked the box there, that they're also related to the 70s. Then we'll get into the themes for 2023. We'll hit the highlighted markets that are sort of in a position to benefit from those themes coming through. And then we'll spend a couple minutes at the end talking about where possibly the next major crisis could come from that we need to be on the lookout for.
Okay. Speaking of the 70s, I'm going to talk to Doug Casey. Remember him?
Yeah. What's he doing these days?
I'll find out.
Yeah, that's very interesting. That's definitely a name.
Yeah. I cut my teeth on crisis investing. That was its book in the 70s. So
yeah, I mean, that's where we are.
Yeah.
So the major cycle that's affecting every human being on the planet, some handling it better than others, is this epic cycle, which is a 400-year cycle that we're in the last 1%, the last 4 years of this cycle. So we are in the sort of fragmentation and dissolution phase where the structures and the way society has been organized and what we've depended on is sort of falling apart right in front of our eyes. And as that happens, it's sort of creating this blue feeling that you were talking about, Dale, and sort of this mistrust and this lack of trust in things and institutions that we used to be able to depend upon. We're not going to be able to do that anymore, and more people are waking up to this every day because of their experiences.
I heard a stat that 78% of Americans suffer from depression.
I think it's
78%.
Yeah, it's going to get worse. It's going to get worse. the ones that I've highlighted here, this slide has sort of all the different things that we've talked about in all the presentations I've done here at F.A.C.E and elsewhere, where we're seeing sort of these large institutions and these organizations and these structures that we've depended on fall apart and begin to fail. The examples are numerous. The ones I want to hone in on now, over Christmas, we saw a major failure in our transportation airline system with these Southwest cancellations. I've talked to some people who were involved in it. They said it was an absolute nightmare. But this is the exact sort of thing that used to be a one-off or an outlier, and now it seems to be happening regularly, where we're seeing something that we took for granted and used in our daily lives is now not reliable anymore. We can't rely on it. So I think the airline debacle is a good example of this. And I also put up this student debt cancellation. Now, why would I put this on this list as an example of a failure of an institution? It's something where there was a contract and there was an agreement and there was a structure that was put in place, which people borrowed billions and trillions of dollars in student loans based on that structure. And in a whim, with the stroke of a pen, they're trying to undo it. And it undermines people's belief in the social contract and in the systems under which we've operated for the last hundreds of years. So this student, while it doesn't seem like a big deal, I believe it's a really, really big deal. And if it actually goes through and it's actually implemented, I think it's going to be another blow to the trust and the confidence that people have in the government and the sort of organizing principles and systems under which we operate.
The one above is going to make that look like a picnic.
There's no questions. And we got the first quake in that one, right? With what happened in the UK. And that's going to be here, Ben. It's going to be massive. It's going to be massive.
I saw that Biden, I think it was $350 billion to the Teamsters.
Yeah.
To shore up their retirement fund.
It's going to be massive because, again, there's a social contract where the organization that was the sort of the initiator of that contract is not living up to their bargain.
The parent took care of their children in the workforce.
Yeah. And it creates that doubt, right? And that uncertainty and that anxiety. And like you said, that feeling of doom and depression.
There'll be a bailout on that in my view, but.
Yeah. So here's the 70s, right? The 70s cycle, which we've talked about. The connections are crazy in terms of the number and what we've seen. This was sort of the first iteration of it, was with Nixon, comparing Nixon with Trump. And you can see, and if you've heard me speak, there's the connections are numerous and they're all there. And you have a Republican, unpopular president with sort of dubious deeds and things all mixed in there. There's only been 4 presidents impeached. Trump and Nixon are 2 of the 4. I mean, it's crazy, but they're the connections. The recent ones we have Jimmy Carter and Joe Biden, and the connections here are mind-boggling as well. I've added a couple new ones because I think they're again showing the strength of this cycle. I should have put this one up earlier last year. It just never dawned on me until I was preparing for this. But when Carter was president, Russia invaded Afghanistan. We funded the Taliban and Osama bin Laden to fight him. Yeah. Now, present day, Russia invades Ukraine. Joe Biden and the U.S. government are funding the Ukrainian opposition to fight them. It's not exactly the same, but man, does it rhyme.
Yeah.
The church committee. I don't know if you know about this one, Dale.
He was a senator?
Yes, Senator Church, a senator from Idaho, Senator Frank Church, established a committee in 1975 to examine the abuses of the intelligence agencies against the American people. CIA, FBI, NSA. There have been calls last year, just in the last month, with the release of the Twitter files and what the FBI and the intelligence agencies and the government was doing to get access to information and sort of spy on people and censor them. There have been calls for a new church committee. Again, it's not a perfect match, but look at the themes that have come up that were present in 1975 and they're coming up again today. And that's the essence of what cycle work is. It doesn't tell you exactly what's going to happen, but it tells you the things that are going to be emphasized, the things that are going to be important, the things that are going to be on people's minds and come up again. And that's what we're seeing. You can see the other things that we're experiencing, obviously stagflation, the commodity boom we saw in the 70s, commodity boom we've had now. The Roe versus Wade decision was made in 73. The overturning of Roe versus Wade, Dobbs versus Jackson was last year. Again, the similarities are there. So having that as your background and understanding that can also help point you in the right direction in terms of, where to invest and what to be, what should do well and what should do poorly. So let's look at the themes that we're going to talk about and that I think are going to be prevalent for this coming year. The first one, again, is the really important one because this is one that's going to be driving people's behavior. And remember, markets are driven by human behavior ultimately. The rapid deterioration in the trust in the system and in the reliability of the system is going to intensify this year. I think what we saw over Christmas with the airlines, with Southwest Airlines, is an example. That sort of thing is going to continue to happen, and it's going to happen more frequently, and it's going to happen with greater intensity and greater failures. Why is that important? Because it's going to put in the minds of more and more people that you cannot trust the system. The system is no longer functioning properly. And that creates a problem that comes next, which is civil unrest. If I can't trust the system, or if the system isn't working for me, why should I follow the rules? Why should I?
Don't you see that manifested, Ben, in all the robberies and shoplifting that isn't prosecuted, that's feeding upon itself? There are now like syndicates that go and steal from retail operations and then resell the products.
100%. 100%. That's an example of it.
I've never seen anything like that. In the 70s, I don't think that happened.
No. And Dale, think of this. It's bad enough when you have that criminal element that's taking advantage of it and doing it. But if it happens the way this sort of deterioration that we're looking at may be happening, when the average person, the normal law-abiding, rule-following person starts saying, why should I follow the rules anymore?
Why should I pay?
Right. Why should I pay if these guys are getting away with it? If there's no punishment for the crimes, why should I follow the law? That's where the danger, that's where the fabric of society comes undone, right? Because then the social contract is gone. So that's one thing we have to be on the lookout for, is that sort of acceleration in that lack of trust in the system and the lack of reliability. Start looking for those kind of events and be prepared, because that is something that the cycles are calling for and saying that the background weather is favoring. The third one kind of feeds into what could also lead to more civil unrest and problems, which is we're now going to be entering into a phase where there is no growth, right? The whole system that we've evolved in and we have developed, and the economic system of the world, is based on growth. If there is no growth, there are problems, because you need growth to generate taxes, to pay for things that you've promised and you've sort of contracted for already. And if we don't have growth, it's going to create big problems in society, because then people aren't going to have money, people aren't going to have services, people aren't going to have food, people aren't going to have shelter, and that's going to create serious problems. The economic ramifications of it in looking at the markets are there's going to need to be a revaluation. If companies aren't growing earnings anymore or aren't growing at the expected rates they were before, there's going to have to be a revaluation and a reassessment of, what kind of multiple are we going to put on those earnings? So it's bad policies, policies that have ran up this debt, policies that have, since the pandemic have discouraged people from working. That this whole, we'll pay you to stay home thing. That's hard to undo. Once that genie's out of the bottle, that's really hard to undo. Not to even add in the mountains of debt, which we're going to talk about also. The fourth theme that I think we have to look at and is really strongly prevalent is war. I think not only are we looking at escalation in Ukraine, in the war between Ukraine and Russia, which we've already seen with, Ukraine sort of, beginning to attack Russian soil and the Russians trying to do other things that they weren't doing before. So the escalation there is already happening. The key here is, and some cycle work I've done shows that there is going to be an expansion. And sometime in the third quarter, in the July-August timeframe, I think we're looking at where, historians are going to say that was the start of World War III.
Okay.
My contention is it's already started, right? But it's a proxy war now. But this will be sometime July, August. We're going to see history tell us that was the start of World War III. So
you want my hunch?
Yeah.
All right. Netanyahu is now back in charge.
Mm-hmm.
So, his number one thing, because of, and Iran is in chaos because of what's happened there. So I think that there could be conflict between Israel and Iran.
Maybe that's the trigger in July. Who knows?
Yeah.
But the cycles are calling for it. It's set up for it. We have a very similar setup as we did in September of in this summer as we did in September of 1939, which was the start of World War II. There's no guarantee it's going to happen. It's just you have to be aware that the odds are higher than normal. We don't get a world war every day, but the odds are much higher than normal this summer that we could have the expansion of the conflict and the beginning of World War III right there. With all that said, all that wonderful cheery news I'm giving, there are going to be major opportunities this year. There's going to be major opportunities in the commodities markets, and believe it or not, there's going to be major opportunities, I think, and based on my work, in the equity markets, which we're going to get into as we run through this. Quickly, let's do a quick review of sort of the environment that we're in and what, based on the cycles and the work that I do, what I'm seeing. A lot of people are calling for the end of inflation, saying, hey, inflation's over. It looks like, as Steve was saying, they're looking at the second derivative, which is the rate of change of the rate of change. You can't maintain that, right? It just, at some point, it's too large, too fast to do. So I put this chart here because in this cycle, you got to get inflation right if you're going to make money in the markets. If you get inflation wrong, you're going to get run over. And what I think we're going to see is something similar to what we saw in this, late 60s to early 80s period, which is waves of inflation. And, maybe we're in that 1970 area where we got the first wave, right? We got the first wave, and now we're not going to see deflation. We're not going to see prices go back to below where they were before, but we're going to see a lower rate of inflation. So disinflation for a year, maybe 6 months, maybe a year and a half if we're lucky. And then the next ramp in inflation is going to come. And the key thing to take from this chart is looking, if you treated it like a stock or like a market, you saw higher highs and higher lows. And I think that's the kind of thing we're going to see throughout this cycle with inflation. You're going to see, we may have seen the first peak, and now we're going to get a pullback in inflation, but it's going to be higher than it was before. Then the next peak's going to be higher than the previous peak. And the next pullback will be higher than the previous pullback. And so I don't see inflation going away for a while. And based on the cycle work, the Fed is going to have to keep rates higher for longer than most people are counting on at this point. So that's the sort of the story on inflation. Let's go to earnings. Earnings growth is not going to be prevalent for a while. The recent estimate I saw on for 2023 for the S&P 500, the consensus is around $223 in earnings for the S&P 500, which if you put a 15 multiple on it, which is a generous multiple, puts you at about $33.50. JP Morgan, I saw, had an estimate of $209 for earnings for the S&P 500 for this year. You put a 15 multiple on that, you're at 3,100. So as you guys were talking about, on the F.A.C.E show before, going back to those pre-COVID highs, it seems like pretty much a no-brainer right now. It's just a matter of what's the path and how are we going to get there. Because the growth, we're not going to grow our way out of this issue and this problem right now. And the cycles are calling for difficulty in growth and no growth, as a matter of fact. And in a few years, not only are we not going to have growth, we're going to have retraction, right? And contraction. So right now we're going to be dealing with the realization setting in that there's not going to be any growth, and how do we revalue these markets based on that? Okay. Here's the bubble. Everybody knows it. The key thing to take from this slide is that the air is going to come out, and it's coming in. So you've already seen the devastation in the cryptos and the NFTs and the most speculative things. As you guys were also saying in the show, NASDAQ has almost taken out, it's really close to taking out October lows, a lot closer than the S&P and way closer than the Dow. So things move in waves, right? Waves and cycles. We've had this massive flooding of the system with liquidity that has raised asset prices. The air's got to come out of the bubble. So what could that possibly mean for equities? This is a chart you probably know all too well, Dale. What happened during the late 60s into the early 80s with equities? They basically went nowhere.
Yeah.
For 15, 20 years.
Yeah, big range.
And could we be looking at something similar? Again, doesn't mean the S&P has to go to 1,000 and crash, right? Maybe we do go to 3,000 or 2,800 and then back up to 4,000 and then back to 3,000 and then back up to 3,800. Maybe we get stuck in this kind of range for, multiple years, heading into, the late 20s, early 30s, early 2030s. Who knows? It's just something you got to keep in mind. Again, if we're connected to that 70s cycle, it's certainly possible. Talking about war, this is another reason why I think the calls that inflation is dead are a little premature. Just look at these inflationary events and the events that happened around the wars that caused inflation. If we do this escalation and this, extension and expansion of this conflict, it generally causes inflation. Governments spend more money. You're destroying a lot of stuff. You got to build a lot of stuff. You got to replace things. So I think we're in for an expansionary and an inflationary period if we do hit a war. What benefits from that? Commodities. I found this chart in a presentation I was looking at last year, and I thought this was really, really interesting because of, this is a 260-year chart looking at commodities and the different cycles. And we're right in this cycle here where, we're coming off a low and rocketing out of it. And you can see other times when that happened. This is your 70s commodity bull here. So I think commodities still have more room to run. They've been correcting for a year now. They're going to correct for a little more time. Maybe it's a potential war this summer. That's the catalyst that gets them really going. But we'll see. The value is there. It's just a matter of timing now for when you want to get in for the next leg up.
We can't have the summer of '69 this year.
I don't think so, buddy.
Oh,
It's not the way the weather forecast is looking.
Build me a time machine.
So here's another interesting chart just showing you, paper versus hard assets. When you're up here at the red line, paper assets are doing much better. When you're down here at the green line, it's when the hard assets are doing. So far, we went from where paper was really performing really well to now we're back to the median. So we got another leg in commodities. Next year or two, 3, we should see a really, really good run in the hard assets again. Okay. Let's go to some charts. I'm bullish on the dollar. I think the turmoil and the lack of confidence and potential war, money and capital will flow to the dollar. So the dollar will be a beneficiary of that. If you look at the monthly chart, we made a nice high and look where the pullback came. That's a bullish pullback if we hold this level. Okay, it's just on the highs from 16, the highs from 20
would be your line in the sand.
Yeah, down in that area.
Okay.
But the dollar, I think the dollar's going to
highs or failing rally.
I think we're going to make new highs.
Okay.
Yep. 120, 130, even potentially if things get really crazy and the capital, looks for safety and flies into the dollar. Other thing, yeah, I think he's right. I think he's on it. Okay. Ultimately, the dollar will suffer the same fate as all of them, which we're going to get to at the very end. But for now, it is the safe haven, and it's where money will flow. Fitting with the epic cycle and this sort of lack of confidence, I think you got to own gold. I think, we've had this pretty strong run the last couple months of the year, so there's probably some sort of pullback. This is a monthly chart, but if you use your dailies or your 4 hours or your lower time frames, you can find a good spot where, it would be bullish to get in on a pullback, but I think gold looks good. Silver's another one. I think silver looks really good. Same thing. It's had a good run. Dale's 22 number is as good as any. Look for a good pullback into that level. That would be right around here is 22, 21, 22.
The other rhyme on silver is the Hunts brothers, right?
There you go, from the 70s. This is one that's going to surprise a lot of people, but I think at some point this year you're going to want to buy some Bitcoin.
Why? How does this fit into the epic cycle?
The main way this fits in, Dale, is this is an off ramp to the current system, right? It's a way to say, you know what? I don't want fiat. I don't want to deal with the government controlling the money supply or controlling my money. I want an alternative. And this is one of the alternatives. I have not been a Bitcoin bull. I've not been on this thing at all. But I think no, I think you're going to get a washout, to anywhere from 8,000 to 12,000. And in that area, I'd start buying some.
Where you have a red vertical line, is that kind of the time frame you'd be looking for something?
Yeah, those are timing lines. Yeah. They things can react on those lines. So
what's the next one coming in? Not that far away.
Again, I would be looking at a panic and risk type thing. So maybe in summertime, if we get a low in risk, Bitcoin probably washes out then, and that might be a decent chance and a decent place to buy. But it's still too early. but I do have it on the radar as a epic cycle type play.
Okay.
Crude. I think energy, it's set up for, we've had this mild winter that's sort of given everybody this false sense of confidence because Europe's not falling apart and having the disaster everyone was talking about over the summer might happen. They were going to freeze and oil was going to be at 200 and natural gas was going to be at 15. Well, I think they're setting record temperatures in Europe. This is going to be the year where oil shines and energy shines. Really, really shines.
Well, the energy stocks never didn't shine all year. Even with the decline in the underlying commodity, XLE was a top performer ETF.
Yeah, I think you got to have exposure to crude, and you got to have exposure to the Widowmaker at some point, which is natural gas.
Yeah.
Because while it was a partial story in 2022, we saw
you
big,
trade it, Ben, or I'll call your wife.
We saw big moves in these markets, and big moves higher. The real story is going to be this year. So we got to watch that. Okay. On equities, here's a monthly on the ES. I added in sort of little timing for when these Ponzi's were exposed. Here was Enron. Yeah. Here was when Lehman and then Madoff were exposed. And here's your SBF FTX debacle.
Yeah.
So I do think we're going to come down here. Stelios's number and the numbers you guys were talking about, I think, 3,100, 3,200 is possible if we get to there, this summer in a good timing window.
Can't we get there in the first quarter?
It's possible. Absolutely possible.
I mean, the way it's rolling.
Yeah. And if we do, like I said, I think there's going to be opportunities. Again, it's not like, it's a 20-year bull market, buy and hold type of thing, but I think you could have a nice, 6 to 18 month type trade on the long side if we get a washout.
Okay.
NQs, here's NQs. You can see the relative weakness here.
Yeah.
Compared to the other ones. But same story, washout coming. Let's be ready. And then we can put the bullhorns on and have some fun to the upside. Quickly, because I know I'm running up against time. I wanted to touch on this because I think this is important. Everybody's looking for a crash and worried about a crash, and I was like, okay, let's look back and look at the crises we've seen. What causes a financial crisis? Lately, in the last 30 years or so, 40 years, it's been excessive debt and then collateral issues.
So credit problems arise in this cycle of the decline in the stock market. We haven't
think about this. We haven't
had credit events yet.
Remember, right? In the great financial crisis, it was mortgages, right?
Yeah.
And in late 80s, early 90s, it was long-term capital management and foreign bonds and foreign debt, right? So there's always a catalyst. The most debt, where's the most debt been issued in this cycle? It's sovereign governments, man.
Yeah.
That's where the problem's going to be. Now, look how my crazy tying this crap in fits together and see what could possibly happen. The epic cycle is about a loss of confidence in the system. If people start seeing that I can't rely on the government to provide the services that they've provided in the past, why am I paying taxes to them?
Because
why should I
put on an extra 150,000?
And why have they put on an extra? Why do they want to spend another $50 billion or $14 billion or whatever it is on the IRS?
Yeah, that's why.
Because they know it.
Yeah.
If people start calling bullshit and say, you know what, I'm not paying taxes anymore, what's going to happen to government bonds? And if government bonds are having trouble, what's the most used instrument for collateral in the world? Government bonds.
Yeah.
Possible.
Yeah.
This is nothing that's going to happen this year. It's probably not going to even happen next year. But at the end of this epic cycle, that may be the doom loop right there. 25, 26. I mean, we're already seeing some sort of.
Yeah, we saw it in the UK.
We saw it in the UK with their pensions, right? They had to immediately back down from what they were trying to do.
We saw it in Japan.
You saw it in
That's
Japan.
why. That's
And
why
those are
they moved.
major economies, because people can dismiss, oh, Lebanon, Sri Lanka, Zambia, they're in default.
Yeah.
Well, they're always in default. Well, Ecuador and Egypt and Ghana and El Salvador, yeah, we know they're in trouble, but they're
Zimbabwe,
third
yeah.
world.
Yeah.
Well, in
Okay.
25 and 26, don't be surprised if this sort of thing comes to the first world. And I mean, here's just a couple quick charts. Public debt's in gold. Look, that's where the growth is, man. Look at it.
Okay. I'm getting a cue. So
Yeah.
if we could wrap it up, because
Yeah, it's all right. I've planted the seed, so now everybody knows about it. If you want to reach me, you can get me on Twitter. Here's my Twitter page.
yeah, Ben, another great presentation, and I give you more time than anybody.
I
In
appreciate
fact,
that,
I
Dale.
was ready to keep going, but Stel is my boss, man.
No
So-
worries. I understand you guys got tight timelines. The key thing, guys, is keep your head. Don't get emotional about things. Watch for opportunities. Look at things that can benefit from these major cycles, and you'll be okay.
And
There's
follow
always an
Ben on
opportunity.
Twitter at Ben Maldonado, and check out his videos on YouTube. They're excellent.
Thank you, Dale. I appreciate it.
Happy New Year, brother.
Same to you. Have a great year. You and all the guys at F.A.C.E have a great year. Hope you all do really, really well.
Thank you, Ben. And thank you, everyone. Hope we added value to what you're trying to accomplish in a difficult endeavor. Join the boys in 4 minutes on the Morning Edge. See what the reaction is to. I have no idea what the markets are doing right now when I do interviews. So get back in tune, and I'll see everyone on Monday. Don't just count your pips, count your blessings. Adios. Thanks, Ben.
See you, Dale.